Unfortunately, retirees have been sold this idea that living off dividends in retirement is either a bad idea or not feasible. Well, today I'm going to explain why you can live off dividends in retirement, what are the benefits of this strategy, and who should consider this option. First, let's define what a sustainable dividend portfolio looks like. Let's take, for example, funds HDV or SCHD. Both are diversified dividend growth funds paying roughly 3.4% yield. So for $1 million portfolio, you would expect to receive $34,000 yearly in dividends, which isn't too bad. As you may notice, this number is not too far off from the traditional 4% rule. Now, I like using dividend growth funds as they provide instant diversification of typically 75 to 100 dividend paying stocks and are much easier to manage than managing and buying all the stocks yourself. Okay, now let's talk about some of the benefits of a dividend portfolio. Here we can see the stock price of VYM, a Vanguard High Dividend Yield ETF going through 2008, right? The fund dropped practically, I think, 50%. Not much different than the market, right? There's no benefit to a dividend portfolio here. But when we come down and look at the portfolio income, the dividends that it produces, the dividends only drop by 25%. So we can see here that dividends are much more stable than the stock price of the funds or stocks they're following. And therefore, it provides some sort of relief in bad market situations because if you can just adjust your spending down, let's say 25%, get you through '08, it can do really great from there. Okay, the second main benefit of a dividend portfolio is it keeps up with inflation quite well, or at least the dividend portfolios I recommend. So here we can see a mix of HDV and SCHD going back from fund inception and how it's grown. The funds have grown over time, inflation adjusted while receiving dividends. So we can see it's kept up quite nice with inflation. Obviously, we've gone through a period of extreme growth here. So I don't think the next decade is going to have this stellar of growth, but you can see here it'll at least keep up with inflation in theory, most likely outpace inflation. But let's go look at the income piece, which obviously is the most important here. Yet again, here we can see the stability of the dividends. Really stable. I think they were flat here. The rest of the time they were up a little bit. You can tell it more than doubles here. You start at 3.4%, $34,000 on $1 million, and it ends up at $85,000 over a little more than a decade. Obviously, this is a fantastic decade, so I don't think this will happen in the future, but you can just see the growth potential of a dividend portfolio if you allow it to grow and you're focusing on growth and not taking, like, if you had a fund that was taking 5% dividends, you're not going to have as much growth. It's a trade-off. So you have to be careful there. Okay. So now to further elaborate, let's talk about this diagram I have here, which is a triangle. And we have growth on top, income stability or risk on the bottom right, and then bottom left is income or yield. This is the income portfolio or dividend portfolio triangle of trade-offs. Okay. So there is no free lunch in investing. And if you want to increase any one of these pieces, right, these are the three main pieces of dividend income, you have to give up another one. Okay. So for example, we could use SPYD, which is a higher yielding dividend fund. But with that, it doesn't grow as much. So it has higher income down here, but it doesn't have the same growth ability up here. And the stability of income drops a little bit. So you can see how there's these trade-offs. And I don't want people to get caught up thinking, well, I got dividends that are paying 8% or something. I'm like, okay, so either there's some sort of credit risk that you're not aware of, that dividends can be cut by a lot or have been in the past, or, it's one single stock that's doing insanely well, something like that. Or it's not keeping up with inflation. More likely it's not keeping up with inflation, or actually you're actually slowly drawing down your portfolio. Another example we can illustrate here is take the difference between a dividend portfolio paying 3.4%, like we've talked about, or treasuries, the 20-year treasury paying like 4.7%. So the 20-year treasury is paying obviously a higher yield, okay, but it has zero growth ability, but it does have completely stable income, right? It's guaranteed by the US government. So you get better income and you get better income stability, but you lose big time on the growth ability. So just know that going in, there's no free lunch. These are the three aspects you should be looking at and understand where each investment, each fund, or if you're doing fixed income, where it falls here, and then overall where your portfolio falls here once it's all put together. Okay, so now let's discuss who should consider dividend income for their retirement, because it is not a one size fits all solution, right? First, those who conceptually enjoy receiving income instead of selling shares. There's certain people, retirees, that enjoy that, and that's why there's been a lot of retirees that take dividend income and they enjoy that, taking income from their portfolio instead of selling shares, right? It's behavioral. It gives retirees more confidence that they're not selling shares, and they don't see their portfolio dropping, and they feel like this is a consistent perpetual income stream, right? It feels like, man, I could get this 3.4% and it grows with inflation, and I can just get it forever throughout all of retirement and never have to sell. Like, it's so great, or I can sell but I don't have to, things like that. A drawback is obviously you have to start with a lower starting withdrawal rate of 3.4% in this case. And I really caution people going above that, right? There's some other funds that can take you into the 4%, but I caution you a little bit there. But let's say here, yeah, you have to accept a lower starting withdrawal rate. So for that convenience of not having to sell shares and do some things like that, or the simplicity of it, or the ability to generate perpetual income, and it gives you a lot of confidence with your retirement, it's a lower starting withdrawal rate. Number three is those looking to pass on their portfolio. Since you never have to sell shares, it's very easy to see how, well, okay, I'm just going to take this income, it's going to grow throughout retirement, and then I'm going to pass it on to the next generation. So if you're interested in building family wealth, or passing on money from generation to generation, and in theory this could be perpetual, that's a great way to do that. And then you have to be willing to accept some sort of uneven dividend payments, right? It's not completely stable. It's not completely, grows perfectly over time with this big of increase or whatever. It's relatively stable. And in market drawbacks, right, it can drop by 25%. So you have to be willing to, in probably a worst case scenario, in theory, right, you have to be willing to take some sort of cut to your income, or maybe you have some cash reserves on the side. I don't want to get into the strategy aspect, but you just have to be willing to accept that in your retirement income planning. If you are interested in learning more about your retirement income style, check out the link in the comments for a free assessment that will point you in the right direction. I'll give you a hint. Dividend income is a part of one of the quadrants, and I'll explain if you get that quadrant. I'll send you a follow-up email explaining everything. Take care.